Welcome to the Corporate Treasury 101 podcast. I'm Hussam.
And I'm Guillaume. In this podcast, we are going through the fundamental concepts of corporate treasury, which I learned from my experience working at a Big Four consulting company.
And you'll explain it in a way that someone like me who knows nothing about the topic can understand.
We hope you enjoy the episode.
Take us through what's like in the overall cash flow conversation. What are those cash flows? We keep saying money in, money out. Can you give us examples of sources of money in or sources of money out, for example?
Very well. Hussam, how do you like accounting?
After corporate treasury is my second favorite.
Exactly the answer I was expecting. So, very good, because it's going to be useful here. We're gonna look into a little bit of accounting, not too much since it's the first time. I know how painful of a topic it is for a lot of people, but let's look into it. So when we talk about cash flow, we often refer to the cash flow statement, which is a financial statement of corporates, right? So in the cash flow statements, and when it comes to treasury and cash flow forecasting, we distinguish three types of cash flows: the operational cash flows, the non-operational cash flows. So here we talk about what cash flows are linked to your day-to-day business and which ones are not, operational and non-operational. And the third one is financing cash flows. So, high level, what is included in here and how do we input all this in our cash flow forecasting? The operational cash flows, we just said it, it's your day-to-day activity. So, a little bit of introduction to accounting terms for the people listening to us. You will look at the AP and AR. What are those? We talk about account payables and account receivables. So either transactions that are going to be paid or transactions that you're going to receive. When it comes to AP and AR, we talk about transactions for which there is an invoice that has been issued. And when corporates issue an invoice, this invoice can be issued with a 30, 60, or even 90 days payment delay, for instance, right? So it's not because you just have an invoice that you need to pay it out immediately. So this is what's going to be taken into account in the in and out as a cash and what you can predict. Now, you also want to look at the payroll, right? The employee's salary, still in these operational cash flows. When it comes to non-operational cash flows, we talk typically about taxes, right? The VAT, the value added taxes, the income tax or capital expenditures, which we call CapEx, which means acquiring, maintaining, or upgrading assets, physical ones or not, for instance, like building, plants, equipment, etc. And when it comes to non-operational cash flows, we also typically talk about restructuring. But we're going to keep this one for another episode. Last one, and then it's the end of this big accounting piece, the financing cash flows. Here we typically talk about all the financing related expenses, obviously. So interest, income, and expenses, for instance. Treasury payments, or all the other financing related transactions such as leases, hedging, for which we just covered in the previous episodes, dividends, debt payments, acquisitions, etc.
That was a lot of accounting. Okay.
So
to summarize then,
yes.
If I got it. You said that the typical types of cash flow you can break down into three, right? So you said operational cash flows, which is your accounts payable and account receivable, meaning money coming in, money coming out for your operational activities, right? You could also say in operational is like employees on payroll, etc. So that's your operating expenses. Then you have non-operational cash flows as your second category of cash flows.
Yes.
Those would be things like taxes, right, which you don't need to pay to operate per se.
Exactly.
Or maybe it's something like CapEx, right? So investing in future assets or maintaining of assets.
Exactly.
So that's not day-to-day operations, but investing for the future. So that's two. So you've got operational, non-operational, and the last one you said was financing cash flows.
Yes.
Which is, we've talked about in previous episodes, right? Your interest income or interest that you need to pay out.
Yes.
So all the expenses linked to financial instruments.
Exactly. Yeah.
So you've got your operational, your non-operational, and your financial.
Absolutely.
Okay.
That's a very good summary, Usam.
No, very good.